Behavioral Finance Notes, Episode 3, Mispricing or Risk, How Can We Tell? Welcome back to Behavioral Finance Notes. In previous notes, we discussed limits to arbitrage and the concept of investor sentiment. Today, I wanted to focus on a deeper question, one that sits at the center of debate between traditional asset pricing and behavioral finance. When we observe abnormal returns or persistent pricing patterns, how do we know whether we are looking at mispricing or simply compensation for risk? The core tension. In finance, this distinction matters enormously. If a strategy generates higher average returns, there are at least two possible explanations. The first explanation is risk-based. Higher returns may simply compensate investors for bearing systematic risk. The second explanation is behavior. Higher returns may reflect predictable mispricing caused by biased beliefs, limited attention, or institutional frictions. At first glance, these two explanations can look very similar in data, and that is precisely the problem. Why this is difficult? Empirically, we observe the prices and returns. We do not directly observe true fundamental value. If a stock appears undervalued relative to some benchmark and later earns high returns, is that evidence of mispricing? Or did that stock simply carry some form of risk that standard models failed to capture? Asset pricing models evolve over time, from cap to multi-factor models, partly in response to this tension. New factors can always be introduced to explain return patterns as risk premia. So the challenge becomes, how do we distinguish between a missing risk factor and a genuine behavioral mispricing? Identification problems. This is fundamentally an identification problem. To claim mispricing, one must argue that, first, the return pattern is not compensation for systematic risk. Two, the pattern is linked to a behavioral mechanism. Three, the missing pricing persists due to limits of arbitrage or frictions. Each of these steps is difficult. Risk is unobservable and model-dependent. Behavioral mechanisms are often inferred rather than directly measured, and arbitrage limits vary across institutional settings. This means that empirical behavioral finance is not simply about documenting anomalies. It's about carefully ruling out alternative risk explanations. A market illustration. Consider episodes where certain categories of stocks, for example, highly speculative or attention-grabbing firms, experience extreme price appreciation followed by reversals. One interpretation is that these patterns reflect investor overreaction and subsequent correction. Another interpretation is that this firms carry crash risk or exposure to macroeconomic uncertainty that is not fully captured by standard models. Without a clear identification strategy, both explanations remain possible. This is why debates between risk-based and behavioral explanation often persist. What this implies for research. For researchers, the key question is not simply does this abnormal exist, but rather what mechanism generates it, and how convincingly can we separate risk from mispricing. Behavioral finance becomes most persuasive when it does not merely document return patterns, but when it links those patterns to measurable behavioral proxies, institutional constraints, or extraordinary shocks. In other words, stronger behavior claims require stronger identification. Closely, the identification between risk and mispricing is unlikely to disappear. It represents an ongoing dialogue between competing frameworks in finance. Understanding this tension helps clarify why asset pricing debates persist and why empirical design plays such a central role in behavioral research. In future notes, I will continue exploring how behavioral mechanisms interact with institutional structures and how we might design more convincing tests. Thank you for watching Behavior Finance Notes.